The world today runs on numbers so large that they seem to belong not to economics, but to mythology. Every nation on Earth, from the wealthiest superpower to the smallest island state, is entangled in debts so vast that the digits barely register in the human mind. The United States owes $38 trillion. Japan owes $9 trillion. Europe, collectively, owes more than $14 trillion. And the entire planet, when all debts are added together, government, corporate, financial, and household, owes more than $315 trillion. That is 3 times the size of the global economy. 3 times everything humanity produces in a year. 3 times more than the sum of all manufactured goods, all services performed, all taxes collected, and all wages earned. Yet the world keeps operating. Markets open. Governments borrow. Businesses run. Citizens work. Debt increases. Nothing collapses. Yet, inside these impossible numbers lies a paradox that should unsettle anyone who pauses to examine it. If every nation owes money, who is the creditor? If all countries are indebted simultaneously, who stands on the opposite side of the ledger? If the world owes $315 trillion, then who exactly is owed $315 trillion? The truth is uncomfortable. The world owes money to itself. The creditors and the debtors are woven into the same system, feeding the same mechanisms, bound together by a structure that has evolved not accidentally, but deliberately. A structure designed over 3 centuries by a small group of men, each living in a different era, each responding to the economic crises of their time, and each unknowingly laying another layer of foundation for a global financial machine that traps nations, institutions, and individuals in permanent indebtedness. This is not conspiracy theory. This is documented history. The meetings took place. The contracts were signed. The institutions still exist. The logic is written openly in financial law, in central bank policy, in sovereign debt markets, and in the very architecture of modern money. 4 architects, 4 turning points, 4 designs that combined into a single system where governments borrow forever, interest flows eternally upward, and debt is never repaid, only expanded. What seems like a global failure is, in fact, a global design. Before the year 1694, the financial world was brutally simple. Kings and rulers borrowed money directly from merchants, nobles, and wealthy families. They paid interest on those loans, and when they could not pay the principal, they defaulted. A default, while painful, cleared the system. The lender lost money, the king found new lenders, and the economy reset. Debt was temporary. It always reached an end. It was repaid or erased. That world changed forever with the appearance of William Paterson, a Scottish thinker, merchant, and failed entrepreneur who would become the first architect of the debt system. England was fighting an expensive war with France. The treasury was empty. Tax revenues were insufficient. Traditional lenders refused new credit. England had defaulted before, and its financial reputation was poor. Paterson approached King William III with a radical idea. A group of wealthy merchants would lend the government £1.2 million, an enormous sum equivalent to hundreds of millions today. But the loan came with a revolutionary condition. The principal would never be repaid. Instead, the government would pay interest, 8% annually, forever. Eternal interest, eternal revenue, eternal dependence. To administer this novel financial structure, Paterson proposed creating a new institution, unlike anything that had existed before: the Bank of England. The merchants would deposit their gold into the bank. The bank would lend the gold to the government. The government would pay interest to the bank, and the bank would transfer that interest to the merchant lenders. The principal, however, would remain forever untouched. This was the birth of permanent national debt. Patterson's deeper brilliance lay in a second feature of his design. The banknotes issued by the Bank of England would be backed not by gold, but by the government's debt. That meant the bank could issue more notes, more money, based on the government's borrowing. Money was no longer tied strictly to precious metals. It was tied to the promises made by government. Debt itself became money. The template for modern finance was created. Governments borrow endlessly, never repay principal, pay interest with taxes, and the debt becomes the backing for newly created money. This model spread across Europe. France copied it. The Netherlands formalized it. And decades later, the young United States adopted it under Alexander Hamilton. The world would never return to the older model of temporary debt. Debt had become a permanent feature of national life, a constant companion to taxation, a stable source of revenue for lenders, and the first pillar of the global financial trap. By the early 1800s, governments were taking loans regularly for war, infrastructure, and operating expenses. But there was no unified, industrialized market for sovereign debt. Each loan required negotiation. Interest rates varied widely. Only the wealthiest merchants participated. This changed under the second architect, Nathan Rothschild, the London branch head of the most powerful banking family in Europe. The Rothschilds, 5 brothers in 5 financial capitals, created the fastest intelligence network on the continent. They could move information, gold, and credit faster than any government. Nathan Rothschild's innovation was simple and devastatingly effective. He turned government loans into tradable commodities. Instead of lending directly to governments, he purchased their bonds at a discount, then resold them to investors at a markup. This created a secondary market in sovereign debt, an open marketplace where nations could raise money quickly and investors could trade bonds like any other asset. Rothschild turned sovereign debt into a global product. The most famous demonstration of his power came during the Battle of Waterloo. Through his intelligence network, Rothschild learned of Napoleon's defeat before the British government. He used this knowledge strategically. He sold British bonds, triggering panic and a collapse in prices. Then he bought massive quantities at the bottom. When the victory was announced the next day, prices soared, and Rothschild made a profit equivalent to hundreds of millions today. Not illegal, simply the power of superior information and liquidity. But Rothschild's most consequential contribution was not his wealth. It was the interconnectedness he created. By selling bonds across borders, he ensured that debt obligations were held by investors in multiple countries. A British bond might be owned by a French investor who sold it to a German bank, which used it as collateral for a loan to an Austrian aristocrat. The web was complex, fragile, and global. A sovereign default no longer harmed just one lender. It threatened the entire European financial network. Default became politically impossible. Nations were forced to refinance, extend, roll over, and continue paying interest indefinitely. Debt became not just permanent, but unavoidable. By 1900, America had grown into a major economic force but lacked a unified financial system. Banks were independent, currencies varied, and the money supply was tied to gold. Financial panics were common. The most severe occurred in 1907, when banks collapsed, markets crashed, and credit evaporated. In the chaos, one man, J.P. Morgan, acted as the unofficial central banker of the United States. Morgan gathered the largest bankers in his private library, locked the doors, and forced them to pledge their own money to rescue failing institutions. The panic ended, but the episode revealed a structural truth. America needed a central bank. Morgan and his allies understood that a central bank would give them extraordinary influence over the nation's credit system. But Americans distrusted central banking deeply. The first and second banks of the United States had been shut down by populist movements. So Morgan's group acted in secrecy. In 1910, a small circle of bankers and Senator Nelson Aldrich traveled to Jekyll Island, Georgia, under assumed names and with strict instructions never to use each other's real identities. There, over 9 days, they drafted the blueprint for the Federal Reserve, an institution that looked decentralized but was controlled by the very banks it regulated. The Federal Reserve Act passed in 1913. Few members of Congress understood its mechanics, but its implications were staggering. The Federal Reserve could now create money and use that money to purchase government bonds. This meant that the government had a guaranteed buyer for its debt. There was no longer a natural limit on borrowing. Debt could expand indefinitely. There would always be a buyer of last resort. Debt became infinite. By the 1970s, this system was global. Developed nations borrowed continuously. Developing nations borrowed for infrastructure and industrialization. But inflation was rising sharply, eroding confidence in the U.S. dollar. The fourth architect, Paul Volcker, chairman of the Federal Reserve, confronted a crisis that threatened the entire system. To restore confidence, Volcker did the unthinkable. He raised interest rates to 20%. Inflation collapsed. But the consequences were catastrophic for developing nations that had borrowed heavily at lower rates. Their interest payments tripled. Mexico, Brazil, Argentina, and others faced default. A default by these nations would have destroyed the banks that had lent to them, major American banks such as Citibank, Bank of America, and Chase. Volcker refused to allow the system to collapse. Instead, he orchestrated a rescue through the International Monetary Fund. The IMF loaned these countries enough money to continue making interest payments to Western banks. In exchange, they were forced to adopt austerity measures, privatize state assets, and open their economies to foreign control. Their original debts were never forgiven. They were restructured, rolled over into perpetuity. Volcker had perfected the system. Even when nations could not pay, they were not permitted to default. They were refinanced into permanent indebtedness. Today, the machine is complete. Global debt stands at $315 trillion. Governments owe money they can never repay. Corporations rely on debt to operate. Households depend on credit to survive. Financial institutions use debt as collateral to create more debt. The entire system is circular, self-referential, and dependent on constant expansion. In the United States, $20 trillion of government debt is owned by pension funds, insurance companies, banks, mutual funds, and the Federal Reserve. The remaining $18 trillion is owed internally to government trust funds. Every year, taxpayers pay more than $1 trillion in interest. That interest flows upward to financial institutions and wealthy bondholders. It is the single largest wealth transfer in human history. The same is true globally. Japan's debt is owed mostly to Japanese institutions. Europe's debt is held by European banks and the ECB. China's debt is held by domestic banks. The U.S. holds foreign bonds. Foreign nations hold U.S. treasuries. Everyone owes everyone. Default anywhere threatens collapse everywhere. And here is the final truth. The system cannot be dismantled. If the United States attempted to pay off its $38 trillion of debt, the money supply would shrink catastrophically. Because dollars are created when the government borrows. Repaying the debt would destroy those dollars, triggering deflation, depression, and collapse. The same is true globally. If all governments paid off their debts, the world's money supply would fall by 2/3, and global trade would come to a halt. Debt is no longer a flaw. It is the foundation. The world does not borrow despite debt. It borrows because debt is the engine that creates money. 4 architects across 3 centuries built this machine. Patterson made debt permanent.